Good evening, ladies and gentlemen. I'm Dimantha Matthew, Head of Research at First Capital. On behalf of First Capital, I would like to welcome you all for our fourth research conference to discuss Investment Strategy 2021. So today's evening proceedings will be threefold. We'll be starting off with our investment strategy report that we are presenting, and that was published on the 29th of January this year. And then it will be followed by the banking sector presentation, which was published on the 8th of February. And then after that, we'll be going into the panel discussion. The panelists will be a number of eminent economists and banking sector. So you have two ways of posting your questions. You can post it through Zoom in the Q&A section, and whoever is joining through Facebook Live, you can post your questions in the Messenger. So with that, I think we can get the proceedings underway. Investment Strategy 2021. We'll be starting on the presentation. Now, this presentation will be conducted by myself and my research team led by Achudan Srirangan and Hirni Pereira. So from here on, I'll be handing over to Hirni to start the presentation. Over to you, Hirni.
Yes, thank you, Dimantha. Have you all heard of this wise statement which says, an investor without an investment objective is like a traveler without the destination? So this statement shows, as an intelligent investor, you really need to know your investment objectives, where you're going to invest your money, and you need to have a proper investment strategy for that. So here we are to present our investment strategy for 2021, and we really hope our strategy report will help you with valuable insights regarding your valuable investments. So if you all can remember, last time in our strategy report, we said Sri Lankan economy would face with a W-shaped economic recovery. So you all might think, where are we now in this W shape? So according to what we think, we are in the second leg of this W shape. Yes, we witnessed an economic dip, but obviously now we are on the recovery path. So we have seen our private sector credit is improving, and we expect our GDP to improve. And therefore, we are obviously on a recovery path. This recovery path is not going to be a rosy path ahead. Rather, it's going to be a bumpy road. So this is what we are going to talk from our strategy report. And let's look at what is inside the report. So first, we will look at the track record. And then we will look at what are the factors to consider in 2021. And also, we will look at the recommendations in terms of the fixed income and the equity market. So let's look at the track record first. And let's look at the accuracy of our previous forecast. So if you can remember, in April 2020 revision, we said our first quarter bond yield expectations, we will extend up to fourth quarter 2020. And we have further adjusted yield downwards, 1 year by 300 basis points, 5 year and 10 year by 250 basis points. So that's what you can see in the chart in your right hand side. Also, you can see we have further adjusted yield downwards by 50 basis points, assuming a rate cut in September 2020. So although the rate cut was not materialized in September, yields have already adjusted for that. And in 14th May, in our fixed income health score, we saw a slight improvement. So I will explain what is this fixed income health score. It's a scoring system calculated by the First Capital Research by assigning a score for some of the economic variables. So despite this temporary improvement in the fixed income health score, considering the future possible risk, we have increased our spread. That is, we have 1 year and 5 year spread, and the 1 year and the 10 year spread by further 50 basis points. So that's what you can see in the chart in your right hand side. And in September 2020 revision, we said bond yields will gradually move uptrend from the first quarter 2021 onwards. And in line with our expectations, we are already seeing this pressure on the bond yields. and how the bond yields will behave in the latter part of the year will be discussed under the recommendation section. And when it comes to the AWPR, again, we have been mostly accurate. So in September 2020, we said AWPR will bottom out and hover around 6.5 to 7% and also remain below 7%. However, something unusual happened in the fourth quarter 2020. That's where the AWPR fell below the 5-year bond rate because of the lack of private credit, high liquidity in the system, and also because of the rate caps introduced by CBSL. However, in most instances, AWPR has a 6-month lag effect with the 5-year bond rate. And when it comes to the exchange rate, again, we were accurate. So in January 2020, we gave an exchange rate target of 183 to 188. And again, considering the COVID-19 pandemic situation, we have downgraded the exchange rate target to 109 to 194. However, considering the import restrictions imposed by the government, we upgraded the exchange rate target to 186 to 191. And also, we gave an exchange rate target of 195 to 210. Considering there will be some pressure on the exchange rate as the government will start to gradually lift the import restrictions. Next, SPI, our accuracy was mixed. So in January, in January 2020, we gave an SPI target of 7,500. However, considering the COVID-19 situation, we downgraded the SPI target to 4,600 to 4,900. However, better than expected recovery in earnings, we upgraded the SPI target to 5,200 to 5,600 in July, which we revised upwards again to 7,500. So those are our previous forecast. Let's look at what are the factors to consider in 2021. So for the convenience of classification, we have divided these factors into 3 as political, economical, and external. So under the political, we will mainly look at the political stability of the country. And under the external, we will look at GDP, private sector credit, and liquidity, etc. So under the external factors, we will look at the country's credit rating and our ability to raise foreign funding, and also the global fund flow towards emerging markets. So let's look at the political factors. So in terms of the political, we expect a lower risk, and we expect political stability to remain healthy. So that's because in 2019, from the general election, the government secured a 2/3 majority, and we expect we witness a similar result from the budget 2021 as well. And we expect the similar trend to continue in provincial council election, which we expect to be held in the second half of 2021, where the ruling party will be able to get the majority. So this is expected to strengthen the political stability and is expected to strengthen the long-term investments of the country. In terms of the economic front, we expect a bouncy road ahead, as I mentioned earlier, and we expect a moderate risk. However, in terms of the COVID-19 situation of the country, I would say we have managed that to a certain extent. So in the second wave, we have witnessed partial lockdowns from October to November, but that also government started to gradually lift those restrictions. But in the first wave, we had complete lockdowns from the period of April to June. Therefore, what we think is the impact from the second wave is much more less compared to the first wave. And also, if you consider the active number of cases, it has even come to a manageable level. And when we were doing this report, the active number of cases were somewhere around 7,000. But as of today, it has come to somewhere around 6,000 levels. Yes, now to talk about the vaccination process and other economic factors, I hand over the presentation to Dimantha. Over to you, Dimantha.
Thank you, Hiruni. So looking at the vaccination situation, we saw that the government had imported about 500,000 doses of vaccines during the end of January. And then the vaccination process has commenced in early February as expected. In addition to that, the positive sign is that the government is also now looking at mass vaccinations. And with that, basically there could be improved business environment in Sri Lanka. So looking at growth, in terms of GDP growth in 2020, we had already factored in a second wave towards the third quarter of 2020. However, the actual lockdown materialized during the fourth quarter of 2020. So with that, we can actually maintain our GDP growth targets for 2020. We are looking at minus 5.8% there. And if you look at 2021, we are actually upgrading our targets. With the vaccinations coming in and the confidence levels improving, we've upgraded our 2021 target from 2.8% to 3.2%. And in addition, the 2022 target also has been upgraded to 3.8%. So if you look at this report, we are looking at the second leg of W as explained by Hirmi. However, it's going to be a bumpy road to recovery. So basically, you can see that though we are likely to be on a recovery trend, we are likely to experience multiple shocks in the process. So we have a high level of CBSL holdings. Our debt repayments are high. Then there's a likelihood of high depreciation in the currency and possibly a spike in interest rates as well. So all these factors, when you take into account, we are likely to go through multiple shocks. So it's not going to be a rosy picture in terms of recovery. So thus, since we are looking at that sort of shocks, we have named this report on a bumpy road to recovery. So on a global sense, if you look at most of the central banks, they have used almost all the tools that are there in the book. So basically, if you look at monetary policy, we've seen policy rates being cut, then liquidity has been increased across the board by most of the central banks. Then if you take external policies, we've seen capital outflow restrictions being implemented by some of the governments. Also, in addition to that, for the ease of banks, basically they have been given capital buffers, capital adequacy has been eased, then the application of NPLs have been eased. In addition to that, even on the borrowers front, we've seen that there has been implemented credit guarantee schemes as well. So all these have been a positive sign to save the economic situation. So if you look at mostly what has happened during this period, almost all the central banks have been printing their way in the system. So printing money has been a continuous habit. You can see on the right-hand chart how much of the GDP has been, the money printing has happened. So there has been a lot of liquidity that has been pumped into the system, and all these factors have been backed by the modern monetary theory. So if you look at the Sri Lankan outlook, you can see that Sri Lanka also has been following a rather similar trend. We've had CBSL holdings of less than 100 billion, and then it has moved to over 700 billion during 2020. And then with it, we've seen liquidity levels also spiking. So as at end of December, we've seen liquidity over 200 billion. However, it has slightly reduced now, but still it stands at over 100 billion, which is relatively high. So in addition to that, with the liquidity, what we've seen is that we are expecting credit growth to pick up. Last year, we were expecting 6%. Now we've actually got the figures. Credit growth has been recorded at 6.4% for 2020. And when we are going into 2021, we are looking at about the rise of that private sector credit growth, double of what we've seen last year. So we are looking at 12% for 2021 and a similar level for 2022 as well. So with that, to take you through the rest of the economic indicators, we are actually going to hand it over to Achudan. Achudan, over to you.
Yeah, thank you, Dimanta. And first we started with the CCPI. And when we see the CCPI for that, it's going to go up for the main reason actually because we are predicting the currency devaluation in the second quarter and may experience the cost push inflation coming on the second quarter of 2021. The second thing, because the base year of last year also will give some sort of pressure on for this on the mid of the second quarter. For the second one, the trading activity. Because trading activity, we are seeing the recovery in the 2021 for despite the government having a gradual relaxation on the trade restriction with that, and we feel the trade resumption, both import and export, will come to the 2019 90%. With that, and we feel the trade deficit for 2021 stand around like minus $6.5 billion. So with that, we feel the tourism back in because for the Sri Lankan government started with the tourisms now, and with that we feel the service import including tourism it's bottoming out 2020 and that it will rebound back to the 4.5 billion mark, with it include the services and not only tourism. And with that we feel the current account balance surplus for 2021 from the minus of $150 million, which going to come in 2020. So with that, but however, we see the assertive of current balance, but we have the problem in the balance of payment due to the high debt repayment for this year. With that improvement in the trade balance, but still our balance of payment is short of 1.6 billion deficit and may continue on the 1.6 billion mark. For the main reason of this balance payment and all, because government started the last budget, the government started the capex and mainly on this public investment, and government increased the public investment to the 5% of the GDP for next 4 years, and we are seeing this is happening since 2012 also. Government started with the public investment drive, and for that time also the GDP to the public investment was at more than 4%. And with this, and we are not going to see the single digit budget deficit for 2021 and 22. With that, for normally the budget deficits are mostly funded by the local and government, and now we have the foreign currency borrowing options are very limited for the short term, and normally we go for the foreign loan, we go for a sovereigns for the longer term, and then we will go for the loan for the project loan. With the current situation we having a less the chance to go on the foreign loan. Mainly we are going on swaps, and for which is mainly on India 1.5 billion, and from China 1.5 billion, India 1 billion. But in the swaps, the reason is that in India recalled back the swap of 400 million worth of. They are also, we have a doubt on that whether Sri Lanka will secure that 1 billion. For the commercial loan side, we have a more than 700 million we got last year from Chinese bank and the Chinese public bank. For the same thing we are expecting for this year. The bilateral, multilateral, same thing again with the supporting for the public investment of government. We expect from the World Bank and Asian Development Bank $700 million. And foreign direct investment side, we expect because the last year we saw the new factories on starting on a tire and the cement factories. Normally for this foreign direct investment, net figure we are predicting a $600 million for 2021. With that, we feel because we have the high debt repayment of foreign debt repayment, and we have the problem in our short-term financing because we are going into the short-term financing for our reserve. And with that, we feel, and June 2021, we are going to First Capital Research predicting a foreign reserve forecast of 5 billion, and after the paying the sovereign on July, and we feel the short-term the funding line problem, we feel the foreign reserve might end it in 2021 with a 4 billion mark. With this, how we are going to tackle our debt repayment for the following year, because 2021 we have a high debt repayment. How we are going to sort it out, that's I'm handing out Manda for the further discussion on that.
Thank you, Achyutan. So let's look at the overall debt outlook for the coming years. So if you look at the left-hand chart, what we are putting here is the rupee and bond maturities, rupee and dollar bond maturities that we have for 2021. So in rupee terms, we are looking at close to 1 trillion rupees of debt maturities. That is only the bond obligations. So if you look at 2022, a similar figure can be seen for 2022 as well, close to 1 trillion rupees. So 2023 is also not going to be too different to this. And if you look at the overall chart on the right-hand side, what we have here is the total debt maturity. So this includes the overall debt position, including project loans as well. So here for 2021, 2.7 trillion rupees can be seen. So out of that, 41% is foreign currency debt. So on the following years, actually this figure is not coming down, because you need to actually add the short-term treasury bills component that gets added on, and other short-term debt components that get added on a continuous basis. So in addition to that, let's take a closer look at this foreign debt component. So our foreign reserves currently, as at December, stands at $5.7 billion. However, our foreign currency debt maturities, this is excluding the short-term debt, that is the swaps and repo facilities that we have obtained. Excluding that, we have about $5.8 billion of foreign debt. So you can see the foreign reserve cover has actually fallen below 1 time. So that is the first time we've seen that in the recent past. So this is a very risky situation that we have at the moment. So if you add all the short-term swaps and the repo facility that we have obtained from the Fed, so this is a significant amount that we have to roll over. So in addition to that, let's take a look at how the quarterly situation is. So if you take the second and third quarter, we have a high amount of foreign debt maturities. So second quarter, you can see the SLDB maturities are significantly high. However, when you come to the third quarter, specifically in July, we have a sovereign bond maturity. So then you can see that the third quarter, because of that, the foreign debt repayment is onto the high side. And if you take the fourth quarter, foreign debt comes down, but then the rupee debt actually spikes up in the fourth quarter. So in terms of debt, the rupee debt is quite high in the fourth quarter. So this is excluding the project loans that we have to pay on a monthly basis. We estimate that we have around 300 to $400 million of foreign debt in terms of project loans that we have to pay on a monthly basis. So this is in addition to that. So let's look at the government securities portfolio. So basically, what has happened here is you can see that we are into some risky territory here. We have a spike in short-term debt. So the treasury bill portfolio has gone to a significant high. 24% is the figure that we have out of the total government securities portfolio. So this is one of the highest figures that we've seen in the recent past. So you can see mostly all the investors are moving closer to short-term debt. So with the pressure that we are seeing in the market, so there is a tendency for interest rates to move up, the investors are starting to feel the risk in the system at the moment. And with that, to sum up all the economic indicators, I would like to hand over the proceedings to Achyutan to take you through the summary.
Yeah, thank you, Dimanta. And for what the indicators what we discussed, and we have like a 4 positive and the 6 negative for this one, and but we are taking the risk of the whole economy outlook as moderate risk. But despite we having a rising the credit growth and high debt repayment, and despite the rupee depreciation, and we have a positive on the GDP is going to gradually grow and high liquidity, and the main thing is a low lending rate in the market and inflation also under control. With that, we are moving to the external outlook, but we are still remaining weak, but we are putting moderate risk. The reason is for the last presentation when we did it in September, and we mentioned the Sri Lankan debt repayment and the external sector bit vulnerability. We can go for the Sri Lankan government can get the rate cut from those rating agency. As expected, the back-to-back, the Fitch and Standard & Poor's and the Moody's back-to-back rate cut from the rating cut from the September, December, which add more pressure to our rates and the foreign exchange rate. So with that, the fund flows, because with the rate cut or rating cut, and we are not seeing any sort of foreign interest to our bonds or for the stock. The main reason, because the countries which already having the more liquidity in their market, and they are also, we are seeing a rise in the interest rate in the most market, and those funds will be mostly to stay on there for the time being, because rather than the risk to come into the countries as a frontier market. The second one, our government bonds, the foreign holding, that one is drastically reduced for the last 1 year. Because when the 2020 start on January, that's more than 100 billion. For the plus, it reduced and it came down to less than 10 billion, and now we are holding around the 7 billion mark, and we are not seeing it in any more risk on that. And that's why we are giving a moderate risk on the external front. The second one, this is the criteria we discussed about the first capital, the fixed income score actually. For these are the criteria we are looking at mainly of this thing, and we are seeing a high risk in the two category. The first thing is the foreign reserve and the CBS holding. We are seeing high because CBS holding is a printed money. When you take it out, you need to sell dollars to take it out the rupee which you printed already in the market. And we are seeing the low probabilities. It's a market liquidity is not much risky, but inflation and credit growth, we are putting the medium and medium low. But the foreign activity, we are putting a medium high, because we are not seeing a much foreign activities on the card. The secondary criteria, what we are seeing actually, this is mainly coming from without 25% of our score. The rating outlook, external environment, we are seeing a very high risk, and BOT and political, we are seeing a medium to the low. And in investor confidence, with the business confidence index, it's grown up, and we are seeing a 2/3 of government, and we are seeing a confidence in the business. We are putting the medium to low. And with this all, and we are predicting a recommendation, because with this all, only we are predicting how the rates are going to go up with the indicator of first capital, the fixed income score. And now, for now, we are coming to recommendation stage. And for this, what we are going to see actually how the interest rate of bonds going to go up, or how the bond market going to perform, how the stock market going to perform, and finally, it's the most awaited one, how our exchange rate going to be perform in this 2021. For just hand you over Imanda to take through the recommendations.
Thank you very much, Achyutan. So let's dive into the recommendations straight away. We'll start off with the bond market. So bond market, we are actually going to maintain our view that we indicated in the media outlook last year. So we expect pressure on bond yields to rise from the first quarter onwards. We've actually start seeing some pressure towards the end of January and the first half of February as well in the bond yields. So what we are expecting is that this pressure is likely to continue to rise. Three main reasons that we are looking at: high foreign debt repayment, high budget deficit, and also then we have a rise in private sector credit growth, which is likely to be some competition for the government because the government's borrowing requirement from the domestic market remains high because of the high budget deficit that is there. So that competition that is likely to rise will put pressure on rates, and it is likely to move up. So with that, let's look at the First Capital's fixed income health score, how the score is moving, how we have forecasted the score to move over the next few quarters. So as I mentioned, the second and third quarter is where we have the highest amount of risk, and then we expect some sort of relaxation, but the risk remains still medium in the first quarter and the fourth quarter. So what we are actually expecting here is towards the end of the third quarter, there is a likelihood that we may go into a potential IMF program. So with it, there is likely to be some positivity that comes out of it in the mindset of the investor. So with that, the fourth quarter is likely to be somewhat better than the other two quarters. So that's our expectation in terms of the fixed income health score. And then, so overall bond market, we are expecting the yield curve to rise by 150 to 200 basis points over 2021. So we can divide it into two sections. First half, rather less pressure we are likely to see, then slightly higher pressure during the second half of the year. So basically 1 year we are looking at 5 half, 6 half for the 1 year during the first half, then 5 year 7% and 8%, and for the 10 year 7 half, 8 half. So what we are actually expecting here is the bond yields to towards the end of the first quarter to come and touch the bands, lower bands of the yield, bond yield bands here, and then start moving up during the second quarter of the year. And then towards the second half of the year, we think there will be further pressure for the rates. So we are expecting 1 year to be in the range of 6% to 7%, and 5 year 7.5 to 8.5, and 10 year 8% to 9%. So with that, what we are actually expecting is towards the end of the year, the bond yield, so basically the yield curve to start touching the top of the bond yield bands. So as you can see, for this recommendation, we are actually allocating 85% probability here. So we are bearish from the first quarter of 2021 onwards. And also, we would like to give you our expectation for the policy rates. So we are expecting policy rates to also increase. We are looking at potentially 2 rate hikes, possibly towards the second half of the year as the rates start moving up. So we go into the banking rates. So as Hilmi explained the unusual character of the AWPRR, so we expect it to readjust back upwards with the private sector credit growth coming into the picture. We are expecting 12% growth for this year. With that, with the competition with the government to borrow, we think rates are likely to spike here. So towards the end of the year, we are looking at 7% to 8% for AWPR. Exchange rate. So on the exchange rate front, we are looking at for the first half 196 to 202 during the first half of the year. So you can see that during our mid-year outlook, we gave a rather broader expectation, but here we have now narrowed it down. So with that, towards the second half of the year, what we are looking at further depreciation. So we are looking at 205 to 215. So it actually depends on how much of import restrictions are likely to be there. So if the government goes there's less import restrictions, so we are likely to have the exchange rate coming more closer towards 105. However, if there's going to be higher import restrictions, it's likely to move towards 215 levels. So it actually depends on how much of import restrictions are there and the government is likely to provide. So here we are only going to provide a probability of 75%, unlike the other two sections where we provided 85%. So here altogether, I forgot to mention, we are looking at for the year about a 12% depreciation during the year of 2021. So let's look at the equity market now. So as we basically sent during January, we put out equity strategy report on 1st of January, and we already forecasted that we have revised our earnings upwards with the rising consumer demand. So that is mainly because of the spike in the third quarter results, and the spike of the results was way above our expectations. So with that, here what we are looking at is we've upgraded our 2020 expectations, so it's now minus 16% for the year. And however, we are maintaining our growth targets for 2021 at 19%. However, though there is we are maintaining that, you can see from the right hand side chart the actual gain, the absolute number for earnings is actually rising for 2020 and 2021, which gives a higher figure for the SPI. So in our January 1st equity strategy report, we put out a target of 7,000 to 7,500 for the year 2021. However, with unexpectedly, there was a massive surge in the index, and this figure was actually achieved during the first month itself and overshot the target as well. Yeah. So then if we go into the current valuation, so we feel that the market valuations are stretched now. Now we release this report as at 29th of January. So the valuations that you can see here in the PE band graph is as at 29th of January, where the ASPI was in the range of 8,600 range. So basically you can see the huge spike in the index. So we expect the fair value for the market to be in the range of 14 times to 14.5 times in terms of forward PE. And with the market significantly spiking, it has basically overshot our targets, and we feel the market valuations are stretched. So what do we expect now? So we would like to mention that we are going to we have maintained our valuations for the market. So the fair value for the market stands at 7,000 to 7,500. So what is the advice that we can give the investors here is if the market is coming below 7,000, you should be increasing exposure to the market. However, if it's exceeding 7,500, so you should be actually starting to reduce exposure for the market. So that was our recommendation towards the end of January. So what we recommended was to cut your equity portfolio to 90% and So we are looking at it as all equity allocated funds. So you have a 10% cash allocation out of it and a 90% equity allocation. So you would remember that we during 2019 we gradually increased our equity allocation out of the equity allocated funds, gradually increased from 50 to 60, 70, and from in January 2020, we released an equity strategy report explaining that you should invest 100% of your equity allocated funds into the market, and 13 months from there on, now we think the market valuations are stretched and you should be looking at cutting your portfolio. And we are currently only looking at 10% cash allocation. Why are we only looking at 10%? Because there's a lot of, we still think that there's a lot of value in the market, and there's a lot of undervalued counters for you to buy. That's why only 10% cash allocation at the moment. So let's look at what are the events that would prevent our 85% probability. We every day give this forecast. So we look at three specific events that could happen, could change our 85% view, which where the 15% or the minority probability takes place. So another shock similar to COVID-19 in a similar scale would have a major impact. Then net inflows, I'm talking about net foreign inflows of 2 to 3 billion during the first half would be a major boost. And also in addition to that, if we have a significant fund flow towards Sri Lanka, and there is possible rating outlook changes for the towards the positive, also could change our view. So that comes to the end of our presentation, and we would like to basically remind you the second leg of W, Bumpy Road to Recovery, is our theme. And to end the presentation, I would like to hand over to Hirni for the conclusion.
Yes, Vinanta. So as we said before, we think we have been able to give you some valuable insights from our strategy report for your investments. So to discuss further insights about the banking sector, I invite Nisansala Kurupamudali to join with us. So before that, there are two important announcements to make. So if you have any questions, you can post it through Facebook or you can post it through chat box. And also you can download both strategy report and also the banking sector from our website. Thank you.
Thank you, Dimanta, Ashitan, and Hirni for that insightful presentation on economic recovery and what we can expect. Now, let's dive into another interesting area on our banking sector and our expectations. Like a phoenix rising from the ashes, we believe that the banking system will showcase its first signs of recovery in 2021. Now, we all know that the banking system has undergone some tumultuous periods of times over the last 3 years because they had to come into the aid of the economy at various instances. But we now firmly believe, before we dive into those interesting expectations, let's take a recap of 2020 and look at how the banking system showed some major resilience during the height of the pandemic. Now, whilst combating an ongoing pandemic, the Central Bank of Sri Lanka took on accommodative monetary policy stance. So basically, they lowered the interest rates, they injected liquid at multiple junctures, and they did all this in order to aid the government financing. So right from the beginning of 2020, we witnessed multiple policy rate cuts, a reduction in SRR, a reduction in the bank rate, and there were caps introduced on lending products, including housing. So these are the measures the central bank took on in order to induce some sort of economic activity into the system. Now, in order to sustain the low interest rate environment, what the central bank did was they injected liquidity at multiple junctions. So over the last 12 months, you can see a steep rise in market liquidity, and by December 2020, it has ballooned to 232 billion rupees. Now, while sustaining a low interest rate environment, the central bank introduced the moratoriums. Now, these moratoriums were introduced as an aid to the SME and retail businesses because it is of paramount importance to ensure that these businesses stay afloat during this difficult period. So the moratoriums were provided extremely attractive low interest rates, and there were various extensions granted, and the latest extension is till 31st March 2021. Now, while sustaining a low interest rate environment and the moratoriums at attractive interest rates, you can see a vast amount of liquidity in the system. And the reason why there is so much, if you take, for an example, almost all the banks in the banking system, they are all well above the minimum liquidity requirement of 20%, and the sector average hovers at about 35%. So what we can gather from this is that there is a vast amount of liquid system, but not enough credit growth. Capital cushioning. Now, we all know that 2020 was an exceptionally difficult year for banks and businesses alike. So what central bank did was, in order to induce some sort of credit growth into the system, they eased or rather relaxed on the minimum capital adequacy requirements. So if you take a domestically systematic important bank in bucket 2, their previous capital adequacy requirement was at 10%, it was revised to 9%. If you take a domestic systematic important bank in bucket 1, their previous requirement was at 9.5% and it was revised to 8.5%. If you take any other bank which is not categorized as a domestically systematic important bank, their previous requirement was at 8.5% and it was brought to 8%. Now, this is how central bank decided to induce some sort of credit growth into the system. Now, initially, we expected a much higher NPL ratio. We expected NPLs to be as high as 8%, but the actual NPLs recorded at 5.1%. And the reason for this difference is because of the back-to-back moratoriums were extended. So therefore, it resulted in a limitation in the NPL shock into the system. However, of course, the banks with a higher NPL ratio are definitely more susceptible to a higher default rate. Now, what's interesting here is that despite the moratorium extensions granted, the banks, as a safety measure, or rather a precautionary measure, they took on a massive provisioning in 2020 itself. So over the last 5 years, the banks have increased their provisioning by 6-fold. So we firmly believe that impairments have peaked in 2020, and we definitely expect to see some sort of recovery in impairment provisioning in 2021. And now Hiruni will walk you through the importance of digitalization to the banking system. Over to you, Hiruni.
Yes, thank you, Nisansa. So let's look at how the digitalization saves bank from the COVID-19. So we know even before the COVID-19, banks were heavily investing on those digital techniques. And actually, we think COVID-19 gave a platform for the banking sector to test the initiatives of those techniques they introduced before. So this diagram from the McKinsey shows what are the mega trends that got highlighted after the COVID-19 banking trends. So some of the trends like digitalization, focus on the cost and focus on the safety, virtual workforces got more priority, while some of the trends like the sharing economy and the global movement of people and goods witness a decline. So I will explain what is the sharing economy. Sharing economy is an economy built on the basis of sharing resources. Mostly it's built on a technological platform. For an example, Uber is a sharing economy, Airbnb is a sharing economy. So these ventures got less demand for their businesses after the COVID-19 pandemic. So this is how the digitalization have saved bank to get through the COVID-19 lockdown. So if you all can see, for the first time in Sri Lanka, commercial bank, they came up with this WhatsApp banking where you can easily use your WhatsApp messaging app to get done some of the banking activities like requesting for a personal loan, etc. So this actually has speed up the banking processes and also has helped them to reduce their operational cost. This diagram again shows where the banking sector is standing today, and by shifting into more digital channels and by configuring their branch network, how they can reduce their operational cost by 20 to 30% in the medium term. And also you can see with the more usage of digital channels, internet-based payment volumes and also internet-based payment value has increased over time. So you can see an increase from 2018, but there's a notable decline in second quarter 2020 due to the restrictions of COVID-19, but that has recovered in third quarter 2020. So because of the more usage of digital channels, there has been a notable decline in the cost to income ratio of the banking sector. So you can see it has come down from 2010 to 2020. So in 2010, it was somewhere around 70%, but now it has come down to somewhere around 50%. Now, Achyutan will discuss how the economy in transition will contribute to the banking sector. Over to you, Achu.
Yes, thank you, Hirani. For this part, we are going to check, because we discuss about the GDP growth and all in our strategy report, but here we are going to discuss how the GDP growth is going to help for the banking sector. The first one, the vaccine hope. Because the vaccine already started on from the February first week actually, because for this, how it's going to translate into the GDP growth. Because the vaccine is starting on the first shipment, and we are going to give to the frontline workers, and when we are going to give to the military personnel and all, and now it's starting on the call, and then we are going to give to the people who are with the 30 and 60 years old people, the working community also getting vaccine. And with this, and we feel the GDP, it's the vaccine will be relaxation of the COVID-19 control, because you can see in when the COVID-19 is there, the Sri Lankan government put a lot of control on the COVID-19, and slowly those lockdowns will be relaxed, and at last, and they relax the BIA for the tourists into Sri Lanka, and which we feel this vaccine rollout will increase the relaxation in further. With that, we feel because the GDP is going to bouncing back, and because we discussed before in the strategy report, and we predict minus 5.8% growth for 2020, and from the low base, and we are going to see the growth of 3.2 for this year and 3.8 for next year. And with that, we are seeing in the second chart and how the GDP is rebound, because the major sector in GDP, the three segment, it's a rebound very quickly in the third quarter. But in the fourth quarter, we're going through a lockdown, and we feel the some pressure on the GDP. With that, we are predicting a 5.8% growth for 2021. And with that, we are seeing the low interest rate, because the last 10 years, this is the lowest interest rate we witness on the banking rate, and for this will be provide a more private sector credit growth. We feel because last 3 months of the last year, we saw the back-to-back 70 billion private sector credit growth is coming to the private sector, the banking system. We feel with the low interest rate, prevailing interest rate will increase the further private sector credit growth in coming months. We feel with that, and for the private sector credit growth, we forecast for the last year was 6%. It came in on 6.4% for last year, and with that, we feel the private sector credit growth with the GDP growth, we feel that will double to the 12% for this year, and follow the same figure for the next year. And for with that one, we might post a largest the total sum of value on the private sector credit growth next year. And with the private sector credit growth can grow, but the central bank put a lending cap, as Nisa Salah mentioned in the first slide, because central bank put a restriction on some loan, especially on the retail and the small medium enterprises, the loan segment. The first thing is the credit card interest rate reduced, and the bank temporary overdraft. The second one is third one is a gold loan also reduced, and finally the mortgage backed loan also reduced to 7%. For this will hit the banks which are expose more into the smaller medium enterprises, the loan portfolio, and we feel the small retail and the small medium portfolio will be the single digit. With that, and we feel when the retail and the small medium enterprises loans are very low, and we feel that the bank's net interest income and the bank's loan spread going to be under pressure for this year, but that will rebound to the back to the normal percentage by 3.4% the spread, the total banking sector by 2022 with this all, and we feel the banks are took a very precautionary action last year to provide the non-performing loan, and banks are giving moratorium. How those moratorium and how the private sector credit growth going to give going to support for the banks impairment, for that one we're going to discuss about for that thing.
Yes, thank you, Achudan. So we expect impairment to gradually ease off with the revival of business activities. So as you all can see in the first chart, the business condition index, which shows the overall general well-being of the business, has almost recovered to its pre-COVID-19 level, and business demand index, which shows the demand for the business volume, has also shown an increase in third quarter. So with this, with the revival of the economic activities, we think SME sector, which is considered as the backbone of the economy, to normalize their business activities, and this has already reflected in the manufacturing and the service sector PMI, which has almost recovered to the pre-COVID-19 level. Another interesting thing, what we noticed is the moratorium applications after second wave has witnessed a 50% decline compared to the applications we have witnessed in the first wave. So with this revival of the business activities, we expect impairment provision to gradually ease off. And in 2020, we expect the impairment to peak and to record at 79 billion, and thereafter to record a gradual decline. And when it comes to NPL, we expect the NPL ratio to peak in 2021, mainly because of the fact of higher private sector credit that we expect, that is about 12%, and also considering the fact that moratorium will come to an end. However, in 2020, we expect a lower NPL provision compared to 2021. And thereafter, we expect NPL ratio to gradually decline thereafter. So we expect an NPL ratio of 5.3% by 2023. Now, Archudan will explain you how the other income in the banking sector may surge in 2021.
Yeah, thank you, Hiruni. For when you take the banking sector, they have the two set of revenue. One is the interest income, and another one is non-interest income. In Sri Lankan banking system, we are seeing witnessed like for last 5 to 6 years, the 78% of income is coming from interest income and 28% coming from non-interest income. With this pandemic, it's changed the banking system, the revenue stream, because when you have a low interest rate and when you have a less private sector credit growth, and we witnessed the banks are moving into the another income, but they have a limitation. And with that, the first one, the banks, because the sovereign bonds, Sri Lankan sovereign bonds, the prices came down, the yields are went up because of the risk which we seen in the pandemic season, and back-to-back rate, rating agencies cuts also reduced the prices. And with that, Sri Lanka CBSL give permission to the banks to buy those low price sovereign bond, which bought by the most of the three banks. It's the big private banks in Sri Lanka. It's increased the exposure on sovereign bonds, especially commercial HNB and Sampath. And with that, they can post the forex gain actually, because mark to market gain on the sovereign, because after the third quarter last year, we are seeing a very volatile situation in the sovereign bond. The second one, the forex, because the most of the banking having the big bank again, they're having the foreign current asset with them, for especially commercial and Sampath HNB. And we feel with the currency depreciation, what we predict a 12% for this year will give the forex gain for those banks which are in a forex as asset. We feel that one also giving a boost to the banking profitability for 2021. The final for because banking and fees and commission income are contracted because the main fees and income are coming from the service sector, and for the last for 3 quarters, and we are seeing less activities in the import export for the segment, and we feel for this digitalization drive will create a more opportunity to the banks to bring the more fee income, and we feel the 2021 to 23 the fee and income the CAGR will grow 12% from its base value. With that, we are going into the valuation. For with the new addition of the sovereign and the another income increase, we revised our 2020 profitability from the minus the 91 billion to we add up 30 billion will 121 million growth of 15% for 2020 and 21. We further increased the profitability of 34 billion from our forecast to 141 billion with a 17% increase in the profitability, and thereafter we are forecasting a 14% growth. With that, we are seeing because the banking sector had a very high ROE from 2015 and 16, and back to back the capital addition to the banking sector reduced the banking ROE, and the banking profitability also in 2017-18 it's contracted, and with that banking ROE it came down less than 10%, and with that we feel with the 2021-22 profit increase will increase the banking ROE in the near future, for that one giving a banking sector a relief. For with a less ROE, we are seeing the last 8 quarters or 2 years, the banks mostly trade between the 0.5 times of book value to 0.6 times of book value. In the revival of ROE, we feel the banks need to reprice and banks need to go back to the level where they were before in 2016 and 17. It's need to trade around 0.8 to 9, 0.8 times to 9 times of book value. It's banking will need to revalue. With that, and we are giving a recommendation to the bank. It's a long recovery road ahead for the banking sector, and for just handing over to the final presentation to essential to conclude.
Thank you, Achutan. And let me reiterate myself. Like a phoenix rising from the ashes, we believe that the banking system will showcase its first signs of recovery in 2021. And now I'd like to make a small announcement. This entire presentation can be viewed on our website of that is First Capital Holdings PLC. And now for the segment that we've all been waiting for, the panel discussion, which will be conducted by our moderator for this evening, Mr. Dilshan Veerasekara, Director CEO of First Capital Holdings PLC. Over to you, sir.
A very good evening to everyone joining us in today. It's certainly been a very interesting first session so far. Thank you to our research team for that presentation. Um, uh, I would like to remind everyone joining us that you can post your questions in through Zoom as well as I think on the social media platforms, and we will endeavor to answer most of them. I think we've already received quite a few questions, so I think we'll be a bit selective in them. Some of the answers have already been covered, I think, in the presentations we've seen before. However, if you feel you need more clarity, you can always, I think, download the presentation from our website or even contact our research staff for further clarity. So let me first, I would like to introduce our panelists for today. And welcome our four panelists. We have joining us for the panel discussion today, Dr. Nishan Dimel, Research Director at Verite Research, as well as a board member of First Capital Holdings, PLC. We also have Mr. Nandika Buddhipala, the Chief Financial Officer of Commercial Bank of Ceylon, joining us, along with Mr. Dilshan Rodrigo, the Chief Operating Officer of Hatton National Bank PLC, and of course my colleague and head of research Dimantha Matthews here as well. So may I first ask all the panelists if you could really switch on your cameras, and then we can start the sessions with the questions that the participants have posed, as well as maybe opening comments by everyone. Yeah. All right, so I'd like to get started with you, Nishan. And I think we've heard the First Capital Research Team's outlook and GDP forecast. May I also ask you the same question in terms of what is your outlook for the economic recovery in 2021, and in terms of GDP growth over the next 2-3 years? How do you see that panning out for Sri Lanka? Nishan Dimel, if I could invite you to answer that.
Thank you, Dilshan. It's not as fun, I think, doing this over video as when we sit together on a stage and can see each other. But glad to be here, and I think I'll speak not as a director of First Capital, but as myself and as from Verite Research. I thought Dimantha sort of made an interesting forecast. He said 3.2 and 3.8 GDP growth for the next 2 years. The central bank, in contrast, gives 6% for 2021 and 4.5% for 2022. Our own view, I think, is a little more optimistic than perhaps the view that Dimantha has taken, and I'll say why. Basically, if Sri Lanka recovers the same level of production as it did in 2000, as it had in 2019, that would already be upwards of a 4% growth rate, right? So I think if Sri Lanka does 1% better in terms of total production than 2019, that would be a 5% growth rate. So I think that 4 to 5% is really quite achievable for 2021 because we are coming out of a contraction year in which simply recovering to the same level that we already had in 2019 already creates a growth rate of between 4 and 5%. So, and I think whatever we, so therefore this year really is a little easy pickings. And I think the following year, Dimantha had it where it was a little lower this year, and I think a little higher next year. I would almost reverse the trajectory and say we could perhaps have up to 5% plus even this year, but maybe 5% minus the year after, given that the advantage of coming out of a contraction is lost after the end of 2021. So that's without getting down into the brass tacks of drivers of growth and things like that. And I think one of the reasons is the government is focused on stimulating growth and production, and not shy about government spending in order to do that. So that means the government itself is not following a contractionary policy. It's expansionary in terms of money supply by keeping lower interest rates, and it's expansionary in terms of fiscal measures as well. It's not expansionary in terms of imports. And imports often does contribute a lot to growth in past years, as you've seen, but it's expansionary on the fiscal and monetary side both, which I think allows growth to be a little bit higher. Or at least let me say, I would be a little more optimistic than Dimantha's numbers in this regard.
Thank you, Nishan, for that. That's very interesting indeed. If I may move to our next panelist, Nandika, over to you. In your opinion, overall, how has COVID-19 impacted the banking sector so far?
Yeah, thanks. First of all, quite interesting and again, Dimant has been bold enough to come up with these projections. Normally, people do not come up with their predictions. Thank you for that. But all these are kind of with assumptions that we appreciate it. Then the COVID, of course, we have serious impact as far as the banking sector is concerned. Even though we were able to maintain some stability since we build up our reserves and the capital adequacy levels, and as correctly they have identified the provisions came up quite handily, and we were able to kind of go through this bad patch. But when there is contraction in economy, quite natural to the entire economy, except for maybe certain sectors which are not in the banking sector per se. Specifically, the daily income earners and the maybe very small scale kind of guys bottom of the pyramid may not be in the banking sector. So whatever hard hit that they have been getting into may not be very much reflective in the banking balance sheets. But I would say by and large, when you look at the tourism sector, when you look at certain other sectors, even the import sectors, trade, services, when your top line is coming down by maybe about 25-30% or even more than that, then your cash flows are getting affected. There again, you are saddled with your the certain expenditure levels where you need to kind of make your commitments. And then when the cash flows are getting affected, definitely we are going to have a real impact there. But there again, one particular factor is that towards the beginning of the last year, we need to keep in mind the fact that there were a lot of relaxation in the taxation regimes. Those tax benefits really had very good benefit into the bottom line, and specifically to the banking sector stability and the ROE levels as well. That has given a huge amount of support. Then there again, the liquidity. Even as we speak, quite obvious, HNB and commercial, we are in the level of 43-44% kind of liquidity. Others are also not really falling down. They're also pretty much overall, I think it's about 35%. So it's definitely very short, it's very challenging. And our customers have gone through really difficult times. When the customers are going through difficult times, really the banking sector itself is going through a difficult time, even though it was alleviated and compensated through certain policies. Specifically, all were mentioned here. I'm not going to repeat each and every policy rate cuts, how many times it was cut, then the injection of the liquidity into the market, huge amount of liquidity injected, even though at the moment those are going back to the central bank again. So spillover maybe moving forward we can see. So in short, it's a really difficult time for the banking sector, even though we were able to weather through it due to number of the policy decisions which were taken on time. We'll just stop at that point and move forward later. Yeah.
And I think we just lost you for a little while there, Nandika, but I think we got the gist of what you said. Thank you for that. If I may move on to Dilshan, to you. I think building on maybe some of the things Nandik has already pointed out, what do you see as the biggest challenge for the banking sector currently?
First of all, delighted to be a part of this research conference. I remember I have very fond memories of the last time, probably about 2 years back, pre-COVID. So it's physical. It's not as enjoyable as an event like that. But nevertheless, times demand this. So we have to have this virtual conference. First of all, I must also thank Dimantha and his team on an excellent presentation today. I could relate to a lot of things that was mentioned there, but there are certain areas where I may have a little difference in opinion, which probably over the course of the conversations will come through. So to respond to your question as the biggest challenge facing the banking sector, that's a very easy question. Undoubtedly, impairments, right? So, and as was presented in the banking sector review, there was a mention that the impairments provisioning has grown sixfold in the last 4 years. So really, what does that mean? It means that impairments as a percentage of profit before tax moved from 15% in 2017 to over 100% in 2020, right? So that's pretty serious, big numbers for most banks. So the numbers are quite huge, and as it is now, about 15 to 20% of the loan books in banks are on moratoriums. This is over and above the customers that are NPL, which would probably in the banking sector would be in the region of about 5%. So you're talking about 20 to 25% of our total loan book, either in moratoriums and therefore not servicing interest and capital, or NPL and therefore not servicing interest and capital. So that's 1/4 or 1/5 of your loan book. So it's big numbers that we're talking about. So and part of the reason for this in the last year or so, as correctly pointed out by the research team, also is a function of the macroeconomic situation we are in right now. And there has been a lot of provisioning that has been inbuilt covering risk, right? So at least 10 to 15% of our impairment numbers now comprise sovereign risk related provisioning. And so all this, points out to a significant, impact on earnings. So there was this discussion earlier about, that other incomes may surge, right? So there are challenges there. It may seem like that, but digital revenues, as you can see, digital has really taken off, right? And as a bank, pioneering this, we started our digital journey about 6 or 7 years back. We built the infrastructure in terms of centralization, automation of our back officers, process improvements, outsourcing. That whole infrastructure was set up, and we invested significantly on digital products. So there is a huge cost associated with the capital associated with digital and the depreciation that goes in with that. But on the other hand, the incomes are limited because there are certain restrictions the regulator puts on the pricing that you can charge on digital. So although you're beginning to see significant volumes increasing, yet it's not adequate to really meet the cost associated, which is really an overhang of the investments that have been made over the last 3, 4, 5 years of almost a couple of billions a year on technology related investments to support the digital. So that's going to take a little bit more time. Then on exchange, again, yes, the rupee is depreciating, but that doesn't necessarily translate into exchange income. It did for a while, but going forward, again, because of the restrictions on open market operations right now, uh, again by the regulator for obvious reasons, we need to protect the currency. The opportunities to make significant exchange revenues also will be significantly curtailed. So that's one of the things that I had a difference of opinion in terms of other income surge. Yes, it may, but not in the immediate short term, not 2021, certainly, maybe 2022, but yet not certain. It depends a lot on how the macroeconomic variables actually pan out. Then there was also another comment saying that impairments will ease off in 2021 and 22. Again, it's a function really of business recovery, right? So when I say that 15 to 20% of our loan book is on moratoriums, then it really would have an impact as to whether 95% of the businesses are going to recover, or whether 85% of the businesses are going to recover, or 80% of those. And that will bring in completely different numbers to your overall impairment. So particularly given the fact that a majority of our impairment moratoriums are on the tourism sector, and the prospects of quick recovery on the tourism sector is still bleak, given the pressures with regard to COVID related fears. Even if the vaccinations come through, and it might take probably 6 months, for a real recovery to start happening, and that will be spring, summer in the West, which is September onwards. So that's just 3 months of the year. So that translation is not going to happen. You're not going to get the full benefit of that in 2021. So recovery is going to be a huge factor underpinning impairment. And that's why as banks, we have a huge role to play in supporting business recovery. So this is an area at HNB we take very, very seriously in terms of how we can support our customers to manage that. So ultimately, the quick answer to your question is that the number one factor is in terms of, how our impairment numbers going to pan out, and that impact, the knock-on impact of that on earnings. Maybe that's a major factor. Of course, the second and the third factors, of course, would be liquidity. Liquidity is another challenge. Of course, for the bigger banks, like Nandika mentioned, we've actually are flush with liquidity because of flight to quality. A lot of depositors are actually bringing their money to us, and we are extremely uncompetitive of interest rates, given that we don't know what to do with that money. So on the rupee side, we are flushed, but it's not the same for all the institutions. We have, 20 banks and maybe another 60 financial institutions. So the smaller banks and the majority of the financial institutions may not see a deposit growth, right? And so then there's going to be challenges, particularly when NPLs go up very significantly for them. The banking sector NPLs are about 5%, but the financial sector NPLs, the leasing and finance companies, are around 9 and 10%. So, and they are defined on a 6-month payment period, whereas banks are on 3 months. So those challenges really will hamper the overall financial sector in terms of liquidity. So that's something that we need to see how it's going to pan out. It's good for the bigger institutions. That's why consolidation might be preferred, but it's tough for the smaller institutions. And of course, the third challenge is about shifting focus, really focusing on the new areas of growth in the economy: manufacturing, assembly, BPO, KPO, and of course the engine of growth, which is the microfinance and SME, creating those supply chain linkages to help them grow. So I think those are my sort of initial comments, but I'm sure you'll have follow-up questions on that.
Thank you for that perspective very much, Dirshan. And I think some of those numbers are mind-boggling in terms of earnings, NPLs, and how that impact is maybe not really hit the book yet. So thank you very much for that. I'll slightly shift focus now and move more to the stock market and what's happening there. I think most of our viewers must be aware that we've seen a very volatile period in the indices over the last 1.5 months alone. We've seen the ASPI index move up from about 6,800, where it ended last year, up to close to 9,000 on the index, dropped back down, I think today bottoming out at about 7,300 and then recovering back. So pretty volatile. So I think I'll combine two questions, one that has been asked by our audience, and one I think which we were looking at Dimantha sort of ask. So Dimantha, obviously there are arguments to say the stock market is heating up, it's overvalued, stuff like that has been said. So how do you really see, I think from a more medium perspective, the stock performance or the market performance? And I think also someone has asked this question, shares that are overvalued or don't fundamentally reflect the price it's trading at, how should an investor be selective in that investment process? So if you could maybe answer those two questions.
Yeah, thanks, Dilshan. So starting off, what we are actually looking at in terms of valuations for the market, we all know that our market has been significantly volatile, and so has the company earnings. And with that, basically over the years, that is mainly due to the interest rate spike and the huge declines that we've seen over the last 10 years. I think we've at least seen 3 to 4 interest rate spikes and declines over the period, which has affected the earnings of companies and in turn affecting the market valuation. So when you have such a huge spread between the highest rate and the lowest rate, it naturally has a significant impact on the company earnings. So what has happened is overall market PE for such a market is slightly lower than the market PE that is applied for a market that has a sort of a continuous growth rate in terms of earnings. So because of that, we've actually applied somewhere around 14 times to 14.5 times PE for the market. So if you look at the earnings that we saw in the September quarter, there was a major spike in the earnings. So with that earnings was actually way beyond our expectations as well, the recovery in earnings. So also part of it is because of the June quarter lockdown. Some of the companies, especially the manufacturing companies, produced and delivered the orders of June quarter in the September quarter also. So that was part of the reason, and that is why some of the results released now, you're actually experiencing that on a quarter-on-quarter basis. Some of these manufacturing companies are having a declining earnings despite a year-on-year basically significant surplus. So overall, what we are looking at is somewhere in the range of 7,000 to 7,500 for the index for 2021. That is taking into account a 19% growth in earnings for this year. So with that, the advice what we can give you is that basically if the index is falling below the 7,000 mark, we would recommend you to increase exposure into equity, and if it is above 7,500, you should be gradually reducing exposure. So if you look at the current scenario where the market actually hit about 9,000 mark, so the problem here is immediately the market P moves up to closer to the forward P's that we are talking about, moves closer to sort of 20 to, 22 to 24, if I'm correct. So in such a situation, what we feel is that then there's excessive, that can be classified as an overheating of the market, because we have still not really seen the normalized level of earnings of the companies, because there was a lot of volatility in these companies, and we are not too sure whether most of these companies will have the same level of earnings that they had pre-COVID. So with that, that's why we have actually recommended to start cutting your portfolio we started recommending around the 8,600 mark, but only 10%. Why only 10%? That is mainly because if you look at the market, there's a lot of blue chip counters in the market that are significantly undervalued. You can take the banking sector, you can take the food and beverage sector, and even FMCG companies like Hema. So all these companies are there that has the potential to rise. Yes, you should be slowly cutting down your portfolio, but your portfolio that is left should be into these stocks. So that is the main advice that I can give you. So the overheated stocks, it is ideally recommended that you sell out from these stocks. In terms of valuation, the blue chip stocks that are there in the market are currently very attractive, and it is recommended that you buy into these stocks.
Thank you. Thank you for that, Dimanta. So I think uh, the simple answer is choose your stocks. You can't probably look at the market and generalize investments. You have to be selective, and you need to pick your stocks. So I think that's essentially what our message to investors is. I'll move back towards more the macroeconomic side of things, and Nishan Dimel, once again, a question to you. I think we've seen import restrictions being introduced during the pandemic, and it's probably served us well in the short term by curtailing the trade deficit and the foreign exchange outflow. The question to you is, how practical is this in terms of continuing with import restrictions, and how do you see import restrictions, whether it's lifted or continued in the medium term? So we would like to hear from you on that.
Thank you, Dilshan, and thank you, Dimanta. I think I hinted previously that the growth story can be connected to the trade story, and that too much curtailment of trade can actually impact your ability to post growth. And this is the reason that Sri Lanka, when you look at Sri Lanka's import composition, I think you've heard Deshal from Verite also talk about it. 80% is capital or intermediate goods, and only about 20% turns out to be consumption goods. So in that context, even if you cut consumption goods, you are playing with the 20% on which you can make a reduction. So everybody talks about vehicles. Really, they turn out to be the reduction we saw last year. And we didn't see a very big reduction even in 2020, right? So we saw a 20% reduction in imports. And of the consumption goods, the reduction really came from vehicles. But those count for, not a very large chunk, ultimately, of the total import bill. So I think the government's already committed to capital projects. Government is committed to helping production and companies succeed. And in that case, capital and intermediate goods restriction is difficult. And the second part of that story is that last year's reduction really came partially from postponement of payment. So you forced people to have 6 months credit. Now you can't bring that advantage back, right? So that's a one-time thing, and the postponed payments will keep coming. So I think if we saw a 20% reduction in the import bill last year, you're really saying that it will be, and the third thing that helped that was, of course, oil prices fell as well last year, and that's reversing. So really, I think you can't hope to see, just based on the numbers and understanding how the reduction came last year, you can't hope to see such a significant reduction in imports this year. And we may be looking at a reduction of a little over 5% and perhaps maximum 10%, but even that would, I think, be tough to sustain.
Thank you, Nishan. I'd like to move to Nandika once again, and I think something that we've seen and has got a lot of media attention has been the sovereign downgrade. We've seen a couple of downgrades. As a result of that, um, we've also seen some of the larger banks who had international ratings also being downgraded, and in some instances withdrawing those ratings. So Nandika, the question to you really is, how do you see that impacting the banking sector? Is that material, the fact that the sovereign has been downgraded, and as a result, maybe some of the larger banks who had international issuances also been downgraded? How do you see that affecting the banking sector?
Yeah, I think it's a serious issue as far as the not only the banking sector but as the economy as a whole. Now, but interestingly, when we look at banking sector throughout the world, unfortunate thing is that we have a sovereign ceiling. I think maybe except for one or two Indian companies, uh, even even in entire Indian market also there's a sovereign shield as far as the banks are concerned. Even here it's the same. Now, quite interestingly, what we have seen, there was one particular downgrade or negative outlook or something similar some time back. Then even some of the other banks got upgraded as well. Right? So we cannot see sometimes logic behind it. But later on, there again, when the downgrade came through, uh, some of the banks were downgraded by 2 notches. So this definitely has significant issue. There again, when we look at maybe coming back to maybe macro side of it, normally we are not supposed to, it can be debt to GDP can be 90% or it can be even 30-40% for some of the economies. But it does not mean that you need to pay off entire debt within 1 year. So when we have these kind of situations, first the economy is going to get really affected. Where the rollover is not going to take place, the replacement is not going to take place, and then a lot of reluctance, and then there again those channels are going to get restricted. You cannot go to market. Then as a sovereign, they have serious issues there. Then on the top of it, the banking sector, normally what happens, we have our maturity mismatches throughout the world. We are not completely immune to it. If we were try to kind of completely immune to it, then there is no income which is coming through as well. So then as far as foreign front is concerned, our exposure to bills and bonds, we have been talking, Dimantha mentioned it. Then sometimes some of these are kind of funded through maybe sometimes shorter term funds. Then the one fortunate thing is the most of the banks, as far as the commercial bank is concerned, maybe more than 25% of our deposits still those are in foreign currency. That of course we are a bit shielded with, but definitely this kind of downgrade is having severe impact as a whole, even to the banking sector. Our competitiveness, because the banking sector compared to maybe some of the other organizations. The other organizations, when they are in a very specific sector, they bound not to downgrade as severe as the sovereign downgrade. But the sovereign downgrade has complete severe impact, since we are very much exposed, specifically the bigger banks, to entire the balance sheet. We have serious issue there. Then maybe certain counterparties, certain lending agencies, even sometimes some of these, the depositors, we need to convince them. Sometimes they are trying to divert their money into some other markets where they earn it and keep it there even. That's why there are a lot of incentives for them to come back and have their money here. So big volatility, big issues are there, even though we are just able to manage it to a maximum level as we speak. But moving forward, also we'll have certain issues because Dimantha mentioned maybe one of the significant factors is going to be upgrades, where if it is at all, it's going to come through. But normally, once downgrades take place, it takes humongous time for them to come back and upgrade the sovereigns. So likewise, then even the banking upgrades as well. So we have a significant issue there. And there again, when it comes to maybe some of the other neighboring countries, where their sovereign is not triple C, they are much better than that. So their banks, even though, but specifically one particular example, Dilshan, Moody's specifically compared once when they downgraded us, they mentioned the fact that our banking sector is robust as far as the banking sector is concerned compared to even Bangladesh. But look at us now, even with that, we are triple C, the sovereign as well as the most of the banks downgraded by 2 notch. So that's a serious issue for us, and we are just trying to detach ourselves from the sovereign, saying that we have some other mechanisms, but those are not coming through very strongly, because they have all the rating agencies. I'm not pointing out only one. All of them, they say the sovereign shield is a serious issue. So for banking sector, for us to compare it with other markets also, it's a serious issue, because our rating were less than maybe some other neighboring countries.
Thank you.
So
Thank you.
we have serious issue there. Keep it.
Thank you. That's a very clear answer. Thank you very much. I'm moving on to Dilshan, and I think Dilshan, you beautifully articulated, I think, in terms of numbers, how you relate, the moratorium, the NPLs, various things that possibly the outside world doesn't really see, or shown or reflected in your financial statements. So I'm going to really pose a tough one to you. How do you see non-performing advances in the banking sector? Is it curable? Is it a problem that you believe the sector can overcome? Or is it so serious that, we don't know the depth of where that will the impact that will have on the banks or the economy as a whole? Dilshan, I'd like to hear your perspective on that. I think you're on mute, Dilshan, if you could unmute yourself.
So Dilshan, starting from last year, one of the things that we brought in terms of the way in which we manage the business is to look at forecasting in terms of scenarios, right? It's very difficult to be able to make predictions on numbers or predictions on anything without looking at assumptions underlying that. So the simple answer to your question is that it's a function of business recovery. So NPA really is a non-performing advance. So as long as they can become performing again, and the business recovers, revives, then the NPA problem gets resolved, right? So for a while now, it's been almost 24 months for some segments, 12 months for other segments and other businesses, where they have availed of moratoriums. So the question is, as soon as you take off that moratorium, how soon would they be in a position to get up and start running? So that's really, fundamentally how the NPA problem becomes curable. So I can tell you there are some interesting, developments that are taking place. I was in Jaffna just 2 weeks ago. I do a visit to a region every month, and I began to see how suddenly after, I visit Jaffna almost once a year, and this time, for the first time, I heard that there is a lot of optimism that the diaspora are starting to invest and are coming back, right? And that is because many of the people who migrated during the difficult time now are, cooped up in their apartments and flats, the elderly folk, because of COVID. And now they realize, look, it might make no sense. My quality of life with the pension that I get in these overseas countries can go a long way. And I'll have a lot more open spaces if I come back and, set up shop back where I originated from. And I actually saw a couple of commercial agriculture projects taking place on a large scale. So I remain very optimistic. I believe that the recovery, when it does happen, will happen very fast. right? So it's just like, if you postpone your surgery because of COVID, as soon as the hospitals open, you saw how suddenly, all the backlog on the surgery started coming in terms of business. Same way with tourism. So once you really open it up, the potential for this country in terms of ecotourism, herbal tourism, long haul tourism, medical tourism, education tourism is immense, right? So I believe that when things really open up, the backlog can get filled up pretty fast. But in order to do that, don't forget the macroeconomic factors. You have to manage on a macroeconomic standpoint the West and the East. You have to manage your foreign policy. It's not a simple question of saying we will stop importing, but at the same time we love to export. The world is not going to react to that. So there is something called free trade. So we have to really, from a macroeconomic standpoint, from a policymaker standpoint, think this through very carefully, from a long-term perspective, and then address those aspects if we really want this recovery, first of all, to happen and also to last. Because what we want is sustainable recovery when it does happen. So I was at Nandika and I both, I think, were there at the Most Admired Company Awards yesterday. And the BCG, head of BCG, I think in India, made a webinar presentation. And he said that 14% of the companies, based on their research in India, I believe, have recovered better post-COVID than before. They are doing better after COVID than they did before. 36% of the companies are almost on par with their situation before COVID. 50% of the companies haven't recovered. You see, so this is the challenge. How do we make our companies, is it visioning? A guy who was importing shoes and selling here, can he set up his own manufacturing plant? Or is it about supply chain linkages, connecting the farmer in Jaffna to 200 households in Colombo and getting them through a digital platform to do transactions? Or is it in terms of the digital products and getting them to onboard as merchants and as customers to have the confidence to be able to do their business and connect directly? So all these factors have to come together for that recovery to take place. And NPA is really a function of business recovery. The sooner it happens and the faster it happens and the more sustainable it is, it will be better for the country, the businesses, and ultimately to the banking sector. So it's difficult. I'm sorry if I can't give you a very precise answer, but really it's really about your perspective in terms of these things happening. And there is a lot of things that are controllable by us bankers, and there are also things that are relatively uncontrollable. We have to rely on foreign policy, the macroeconomic situation also coming through for this to happen.
Thank you, Dilshan. I think you answered that brilliantly well, and I think the very encouraging fact is the ground reality. Also, obviously, venturing out of the Western province and in the regions, to hear that there is a lot of optimism from the diaspora in the northern parts of the country is very, very encouraging. So thank you for that. Dimanta, I'm going to quickly move to you. I think we've got some questions on this from the audience as well, which is that First Capital keeps revising its economic outlook and reports periodically, and so I think we've got some flack for that. And there's a question asking, how do you explain, how do you justify, or can you explain the process for that revision, and how do you justify those revisions?
Yeah. So Vishan, basically what happened was 2020 was a very tough year for us. It was a significantly uncertain year with COVID coming in. It sort of was a black swan event, you can say. So something which where post the situation, you're uncertain of what the outcome is going to be, how long it's going to last, and basically it's a new phenomenon. And would we go into a new normal with COVID was a question when COVID came during March 2020. So immediately with COVID coming in, we had to actually uh, do a revision on our January forecast on all segments. So fixed income, equity, exchange rates, so all on all fronts, we did a quick revision, and we were mostly bearish, and basically we had to do that revision due to that situation of uncertainty. And then when you come to about May-June period, what happened was we had some sort of uncertainty of or some sort of certainty as to when uh, these lockdowns were going to end, how long possibly this is going to last. So we did some sort of assumptions, and then we put out a immediate revision based on those cases. Afterwards, what happened was we actually delayed our media outlook as well, and we put out our media outlook in September, and that is mainly to understand basically how the certainty is going to last, how the recovery of companies is happening, and how the economic factors are impacting the economy. So that is where we came up with our normal traditional second half outlook, and that was with more certainty, and with that only so from April to that September period, we had to go through that uncertainty, but we had to keep our investors updated on the different products as to what they are happening. So because of that, we did revisions, and from here on, now what happens is we are more certain of the recovery, and that certainty give us the opportunity to do more reliable forecasts. So with that, we will, I think, we are not required to do many revisions now on. I think now the situation is much more stable, and reasonable assumptions are possible at the moment.
Thank you, Dimanta, for clarifying that. If I may move now back to Nishan Nimel, I think economic policymakers world over have been resorting to modern monetary theory to navigate these uncertain times. Nishan, I'd like to ask you, what's your opinion of MMT, and what do you see the implications of MMT for the Sri Lankan economy? Because we all know Central Bank of Sri Lanka has been following suit as well. So what are your views on MMT, and how do you see that implicating our economy?
Thank you, Dilshan. MMT is something around which there is a lot of confusion, I think, not just in Sri Lanka, but perhaps globally. So let me say perhaps three things about it. The first is that, even though we call it modern monetary theory, as it is specified, it doesn't quite meet the criteria of a theory. It's a set of arguments, policy positions that people have found to be quite persuasive in terms of a thought process. But there is no well-defined theory around what we call modern monetary theory. And so in a sense, I think the interest in MMT perhaps isn't very well thought out yet. And the related problem for Sri Lanka is that even where it is argued somewhat persuasively, it is argued for countries in which they have currencies that are globalized, and the borrowing is in their own currency often, most of it, and also where the economies are hugely open, so very significant, highly open economies. So I think both the lack of clarity or precision about what MMT is, and clearly the lack of relevance, even in terms of its arguments for Sri Lanka, I think is the first thing to understand. Secondly, I think, the core idea of MMT is quite clear. That is that you can substitute monetary policy or monetary tools with fiscal tools, which, to be precise, that you can, instead of using interest rates, moving interest rates up and down, to manage both stimulation and contraction of the economy, that you can switch that and depend solely on government spending and taxation as a way to manage that, which means that if you are adopting MMT, you have to be willing to allow tax rates and government's ability to take excess money out to happen through the fiscal system than by interest rates. So, for instance, when the government promises that tax rates will be low and stable, and interest rates will be low and stable, now you can't. That's not really very coherent, even in terms of the core idea of MMT, because MMT does ask you to give up, a monetary policy standard asks you to give up fixed interest rates, and MMT asks you to give up maybe fixed taxation policies. So you can't have it both ways, I think, and that's quite important to understand. Thirdly, I think often people misunderstand MMT to mean deficit financing of government spending. Actually, that's kind of a confusion between means and ends. MMT doesn't sort of somehow sanction deficit financing as a solution. It sanctions it as a means to a solution, which is that government will spend money in a way that creates employment and increases production in an economy that is underproducing. So I think if all you do is take deficit financing, what we call printing money, and giving it to government, but then the second part of how government spends it to create employment and increase production isn't taking place. In Sri Lanka, we spend really over about 65% of our revenue on servicing interest on loans, another 65 plus on just paying salaries and pensions to government servants. So these are not production or employment enhancing, because it's not having that function. So I think so my third problem is that that perhaps we are trying to take just this little mechanism that MMT has to achieve a certain end, and looking at it as the end in itself, which is perhaps a significant misunderstanding of how to apply MMT in any case. So just to summarize, I think there is a lack of clarity on what MMT is and a lack of relevance in a sense to Sri Lanka. There is a lack of coherence in how we are adopting policy that we claim to be MMT. And there may be a misunderstanding of thinking that deficit spending or printing money achieves the MMT kind of outcome, when it is how you spend it, not how you finance it, that achieves the outcome. And the real, the real proof of this problem of actually not being clear of what you're doing is that today you cannot find either in the Treasury or in the central bank a single paper that analyzes the understanding of MMT and looks at its application and why it would succeed in Sri Lanka. So there is no document, no analysis. And normally you don't get into such very significant changes in policy without thinking it through a little bit. So it doesn't mean, Dilshan, just to end, that innovative ways of managing the macroeconomy are not available. They are. We must look at the world is changing, and we must change with the new things we find. But we are unlikely to stumble upon the right formula by playing a sort of blind man's buff over how you manage the economy. So I think a little more thinking and rigor is required, and MMT might be too superficial a way in which we are talking about MMT right now. Yeah.
Thank you, Nishan, for that. Thank you very much. I'd like to move back to Nandika. I think we are closing in on our time. We have probably about another 15 minutes left of this session. Nandika, I think the final question going to probably you before I give all of you all maybe a little bit of time to give your closing remarks. Is what is your outlook on interest rates, inflation, and exchange rates, and how do you see that impacting the banks positively or negatively?
It's the most difficult question that you pose to anybody. Because as I think the Nishan fortunately has given a lot of backdrop to certain uncertainties, certain policy measures, certain economic behavior, certain theoretical background. There again, maybe when we look at the interest rates per se, even I think one of the, if even Nishan had the time, he would have really gone into it, I think, dominant currency paradigm, where maybe MMT might be relevant to those kind of countries where they have dominance, and they are again they are internally by having helicopter money is not going to kick on the inflation, and because those inflation is pushed into the emerging markets. So it's the huge problem in the sense how not only the policy measures. When you look at small open economies, we are very vulnerable because we cannot really control through our even fiscal policies or even monetary policies, because we are overshadowed with the certain other factors. We are going to be just price takers over there. Given that kind of backdrop, it's going to be very difficult for us to give predictions on the interest rates and the exchange rates and other kind of things. But maybe what we look at the moment is now one of the factor that we need to look at is the output gap. To what extent that we can go ahead with the economy, whether we are up to the full potential, whether we are down with the full potential. I think we are a bit down with our full potential, not only during this year, last year due to COVID, even the year before, even due to these attacks, even 1 year before due to certain other circumstances, political uncertainty, and a lot of issues. Given that, I feel even some amount of this printed money and excess liquidity in the marketplace, maybe going a bit contrary to maybe the Mantha's prediction, where after the second quarter, half the year, interest rates are going to kick up. Maybe can get a bit delayed than that. So I feel that's why we have seen kind of a big revival. Even that will address some amount of NPA issues also. Now, since we are lackluster kind of, and growth rates were very low for a couple of years, not only for the last year, negative, maybe 5-6 different predictions are there. But we are going to come up, and if even the rating agencies who have downgraded us, just mentioned earlier also in one of the occasions, where they also say our growth can be 3%. So, then how it is going to get converted into consumption? Even the consumption, whose hands this money is going to get into? If it is going to get into in the hands of the people who has big the marginal propensity to consume, since the import restrictions are there, then maybe there is some amount of revival. Since we have this particular output gap, I think to a certain extent we should be able to manage the situation. Interest rates maybe even after second half. Now, since the excess liquidity asset ratio, not only for commercial bank and the HNB, but even the banking sector, I say it's 35-36%, as the Mantha mentioned. So that amount of money, and there again, the economic activities which are going to take place can maybe to a certain extent should be able to manage it even further down. But the exchange rate is going to be another severe problem, where maybe not the theoretical backdrop as such, but the people's perception is going to have a serious issue. Now, people get into panic and they think now it is the time that everything is going to come into a standstill. Yes, we have issues, we know that. So that can rampant the issues in the exchange rate. The managing it's going to be quite tough rather than the interest rates. There again, interest rates maybe sometimes when you look at the local currency bills and bonds, the investor, the foreign funds, are really already dropped it and they have gone off, then the interest rates might not have that kind of a huge volatility, because that has already been taken place now. And there again, the government incentive to manage the interest rate, not only for the economic growth, but for them to survive, as Nishan also mentioned, maybe 40 to 50% is going to go into the interest payments, and significant chunk of it to the local currency interest. So by looking at it, I think maybe I think I will stop it at that point. Otherwise, discussion is going to go for a long way. But I think interest rates might be there at current levels, maybe rather than what Dimanta mentioned, maybe after the first half also, it will keep at low level. But the exchange rate, we need to see how we are going to manage these perception issues, as well as coming up with some coherent way to manage our debt. That will give the answer to, yeah.
Thank you, Nandika. Thank you very much for that. Dilshan, I'll move to you for your final question. Is in terms of the pandemic, and how has the pandemic helped the banks, customers, regulators to really accept digital tech in finance? And maybe you can talk about your own experience at HNB of how the pandemic has helped evolve the digital banking space.
So there has been a a joke that has been going around in the last about 10 months or so, as to what has been the biggest driving force on digital. Is it the CEO? Is it the CTO? Or is it COVID-19? So the answer is yes. So as far as we are concerned, I must say, driving paperless, cashless economy has been really a key focus, and it has accelerated the focus in banks, and the regulator also has played a massive role. A couple of things that they did in terms of enabling non-face-to-face identification for account opening, then driving the Lanka QR project, which is really about driving wallet business. So these things, and also right now there is also a connection that is happening with the Department of Registrations, again to support the non-face-to-face identification of our customers, so that the mobility is not necessary, facilitates mobile banking, internet banking, tab banking for account opening, and being able to take a loan, take a credit card, again without having to physically visit a branch, but through digital channels to enable things that we never did before. So that's a really strong thing. And imagine a situation very soon where you are able to send money to someone just on the mobile phone, just as easy as you send a WhatsApp message to somebody. So that's where we are getting to, and it's very close. And that we knew this was the plan for the country. We were talking about the ID project, where digitalizing the identification. A lot of those things got delayed for a long time, but post-COVID, regulatory focus, Lanka Clear focus, banks focus, everything got really accelerated, and that's a great thing. And you can see now even this call, now it's part of a normal sort of new norm for students, for seminars, conferences, training, recruitments. All this now happens through digital channels, and it has its pluses and minuses, but that's really the new norm, and we have to adapt to that. So as far as the bank is concerned, the journey for us started as much as 5 years or 6 years back, because we saw 2020 as a year where as a a fundamental year where we need to strive to bring in digital, really drive digital. So that's where all the investments started pouring in to support the digital infrastructure. And in addition to that, we made a lot of changes. Brought our back officers to the center, ran what we call a hub and spoke model, where the branches become the sales and delivery centers, and the centers do the credit processing, centralized operations. We outsourced our ATMs and the digital channels. So a lot of work happened in terms of the structure, the processes, the systems in which we work. Driving a paperless office is another thing that we did 4 or 5 years back. So all that to support us for this year of 2020. Unfortunately, COVID struck and a lot of our ambitions got sidetracked quite a bit. But in terms of the digital journey, it only accelerated our efforts and also our confidence, as well as our focus to really drive this very aggressively. So our targets are huge. Immediately post-COVID, we saw a surge in our IPG, Internet Payment Gateway transactions, like never before. And I'm sure a lot of the other banks who had been prepared also saw a similar spike. Then we, introduced a bank in a box where people used to go with in their vehicles with the mobile digital with the CDM, the cash dispensing machine or the cash accepting machines, recyclers going to people's doorsteps, and then people coming and doing their banking there. A lot of investment also. We accelerated the upgrade of our mobile banking, internet banking, tab banking infrastructure, upgraded our infrastructure on the wallet. So a lot of things happened, and a lot of things are happening right now because this is really about preparing for the new normal. And as a mainstream bank, one of the older traditional banks, we are very much wary that there are other institutions, banks and non-banks alike, who are coming into this space. In the digital space, it's a new, almost a new marketplace all over again. So we are very wary of the fact that we really need to step up our efforts here and also partner with our customers, support them. Again, getting back to my theme today, business recovery. How do we support businesses through digital to come out of the situation they are in? So that drive we see as a huge opportunity going forward through this exercise.
Thank you. Thank you very much, Dilshan, for that. Dimant, the last question for you. I think it's more technical question. What's the best way to hedge against inflation in Sri Lanka?
Yeah. So basically, if you look at trying to hedge against inflation now, the interesting part is I think this year we are likely to face a bit of inflation going forward with possibly the currency depreciating, and there could be a bit of cost push inflation coming into play. So ideally, having cash on your hand is going to be basically adverse for you. Ideal situation is if you can invest that in another instrument. Like for example, if you can invest in real estate, what would happen is with the inflation or even a significant devaluation of the currency, what would happen is a country's assets would actually reprice itself after that sort of a depreciation or an high inflation drive. So with that ideal situation is there are a number of ways that you can products that you can invest. So stay invested without having cash. So that would be one of the best ways for you to hedge yourself. Also, another thing, I think one of the questions where some of the investors were asking about the banking and the insurance side of it, what our view is. I just want to highlight, obviously, the banking side. We are very positive in the coming couple of years. Actually, that's why we put out this report. However, On the insurance side, we are very positive on the life insurance aspect of it. As you know, we are expecting rates to slowly, gradually rise in the coming year in 2021. And with it, what happens is the uh, life fund actually the valuations would move down with the interest rates moving up, and then the transfer that these life insurance companies have to these funds, the provisioning that they have to do reduces, which boosts profitability. So because of that, we are very positive on insurance companies, just to answer that question.
Thank you, Dimanta. So I think we've sort of come to the end of this discussion. I would like to give an opportunity for all the panelists to maybe make some closing remarks. We'll start off with Nishan Dimel. Any closing remarks?
Sure, Dilshan. I think looking forward in terms of what is it that the government may need to do to get us on this sort of optimistic path that we are all hoping Sri Lanka will get on. I was just thinking, listening to everybody, perhaps there are three things to kind of put down as critical for government looking forward. And I'll just name them as perhaps credibility, stability, and kind of structural change, right? So let me just start with structural change, because that's what we've spoken least about. You don't fix all the problems in a country by manipulating interest rates or government spending. You've got to fix real problems. And if I just name two, we have, post-harvest loss in this country on agriculture. 28% of the labor force is in agriculture, roundabout. They produce 8% of GDP. It's the most, least productive sector in the country. And if you reduce post-harvest loss, and the opportunity is very high by using simple technologies to reduce it, we can add 1% to GDP. Okay, so I won't go into the details. Another connected structural change really is in the public sector. We are trying to be an upper middle income country with a public sector that's designed for perhaps a much lower income country. And businesses often see the public sector as the enemy of business, not the friend of business. So you can't expect growth and sustained growth in an economy where the public sector is not seen as supportive and professional to do that, and significant reforms needed. That's structural. I think the second is really credibility. We've talked about the balance of payments being the real problem. That I think Dimanta mentioned that, the reserve position, we didn't have enough reserve cover to meet the outflows for next year. And a lot of that problem lies around the lack of credibility of the government in terms of having a plan to manage its debt. There is no debt sustainability plan. So doing what it takes to reestablish credibility. And that's not just with the voters who perhaps don't understand what's going on. It is with those who have a professional assessment of Sri Lanka. And without credibility ultimately has cash consequence and growth consequence. The lack of credibility of the Sri Lankan government's plan to manage its debt is turning out, as everybody has said, extremely costly for the banking sector, for the finance sector, for global trade, and re-establishing credibility is critical. And last, of course, is stability. I think Dimanta mentioned that, we think that we have political stability. I think what's important for the economy is not political stability, but policy stability. And in Sri Lanka, what you see is that actually policy stability is inversely related to political stability. Strong governments change policy far more and more frequently, more in a more arbitrary way than sometimes not so strong governments. I'll just give you numbers. If you look at the central bank report as of October last year, monetary policy changed 20 times in the 10 months. Foreign exchange policy changed 16 times. Policy changes that central bank records itself as having done. Foreign policy, foreign exchange 16 times, price revisions 33 times, and financial sector policy changes 75 times. Now that's 4 to 5 times as many changes as you saw for the whole year in 2019. So those are very serious instability, I think, that you're seeing in policy. Instability in exchange rates to policy creates risk. So what we look as the volatility, the moment you have these movements, they cost because the risk premiums go up. And Sri Lanka is proving to be an extremely risky place to bring your money, to invest your money, to do business, because things change too often and in unpredictable ways. So, structural adjustments, real things that matter, not just financial manipulation. Credibility, have a plan that the world can believe in, and have stability, I think, are really critical ways forward if Sri Lanka is to achieve the kind of growth that I'm hoping we can, and succeed in this year and the next. Thank you.
Thank you, Nishant. Thank you. Very thought-provoking indeed. Can I move to Nandika for your closing comments?
Yeah, I think Nishan has touched on most of the things. It's quite relevant. Maybe down the line, rather than getting into maybe that much of macro, if I were to say specifically, we have gone into now it is W. That's even Dimantha says. What do you mean by W? Always you have volatility. It is not we. It is not you. You that you have a downward kind of trend and you stay there for a while and come upward. Like so, W is always you have this volatility. So we are in a very, very volatile situation, and I quite agree with him. The theme, the W recovery is the one what we are going through. So when you have W kind of recovery, maybe even the policy, the reactions also going to be very volatile as well. That's policies can be sometimes can get changed even, but if we can project ourselves, having some credible plan, specifically when it comes to debt front, it's going to be extremely important at the moment. That we need to project, and that we need to support to project as well. Then the second thing is, then there again we are going into maybe sometimes the import protection kind of policies. Now, as it is discussed most of the time, we cannot be in that particular dilemma all the time. We need to get out of it, because trade is a significant part of the world development and the GDP growth and every other thing. And then the important thing is slowly and rigorously how we are going to come back in these productivity levels. And one of the things in the recent past what has been discussed, we talk about digital translation and we talk about digitization, we talk about it a lot. But out of our population, how many people are quite digitized? And how many of us are quite tech savvy when it comes to AI or analytics or anything? And how many things that we learn in our schools, whereas maybe US and school syllabus, strongly robotics is there. I know there is a move, but there again, it will take a long time. Now, we don't have that much of time. Maybe there can be certain things that we can do quite rapidly that we need to get into it, because the import protection cannot be a long-term solution. It can give some kind of respite, but there again, we need to aggressively come back with our quality, activity, and the credibility in that front. So if we don't have that short-term plans, of course, it should be linked to long-term things. If you don't have that 1 or 2 year, very short-term plans, that will give credibility to the world, credibility to ourselves, and maintain our productivity levels rather than, as Nishan said, 28% of the population producing all this digitization. And I think it's going to be digital divide rather than digitization if we do not act promptly and get into this. I know there are the educational institutions, Grant Commission, a lot of people are into it. That focus also we need to aggressively go on, and very aggressively within 1 or 2 years, we need to have certain targets to address some of these issues in the short run. And the long run, anyway, the macro outfit is going to be a kind of serious issue that we need to address.
Thank you. Thank you.
Point, I think, rather than getting into very long discussion.
Thank you, Nandika, for that. So, if I can quickly move on to Dilshan, closing comments or remarks from you.
Thanks, Dishan. Very interesting, thought-provoking comments from the panel. I don't know what more that I can add except to just re-emphasize what I just said in terms of playing an active role. I think banks need to play an active role in supporting their businesses to come out of these moratoriums and revive themselves. So I think how do you engage with them? How do you support them in that journey is an important thing. I think being active in terms of understanding what is holding them back, supporting them in terms of advisory, in terms of visioning, in terms of supply chain linkages, in terms of the digital products, all that I think is something that the banks will have to play an active role. We have taken for granted a lot of things, and a lot of things that we've taken for granted in the last 2 years have changed because of the Black Swan event that I think Dilshan as well as Dimanta talked about, right? So we have to ensure the safety and stability of the banks because that is tantamount to ensuring the safety and stability of the economy. So in order to do that, we cannot postpone these moratoriums forever, right? At some point in time, businesses have to bounce back. And I think banks have a huge role to play in enabling that because that is going to be the key, at least the things that we can control in the economy to be able to revive. So I think that's my main message. I think Nandika as well as Nishan mentioned the uncontrollable events and also the digital side of it, as well as the macroeconomic decisions that have to be taken to support. But my message would be just about business revival.
Thank you very much, Dilshan, for that. Before we sort of wind up quickly, Dimanta, maybe final thoughts from you.
Yeah. Okay. So basically, I think I would like to give some advice for a normal investor. At the moment, most people, most small-time investors, what they have done is moved from fixed income into equity. So obviously, the fixed income rates have actually significantly come down. So I think on the equity front also, we need, as the market moves up, we need to start reducing exposure there as well. So ideal situation is to move into some kind of short-term instruments. You have a lot of unit trusts in the industry, so money market fund would be a ideal place to park money. So some of the banks or even financial investment institutions have these sort of funds. So that is something what investors could consider. In addition to that, possibly real estate is another area that could be a viable option for investment. So in addition, REITs is something that could come up in the future. So look out for that. But at the moment, ideally on the fixed income side, you should be on short-term instruments at the moment.
Thank you, Dimanta, and I think we've had a marathon 2.5 hour session with the presentations and the panel discussion. I would like to extend huge thanks to the three panelists, Nishan, Nandika, and Dilshan, for joining us. I think for the second year running. Thank you, Dimanta and his team, for providing the presentations and the research material. I do apologize to our viewers if we've not maybe covered some of the questions, because I think we tried to cover most of them. However, like I said, I think you'll find the answers in the presentations. You would have access to the recordings that can be viewed leisurely. And you can even contact our research team for any further clarification. So here's hoping that we will end this online sessions maybe this year and hopefully be able to meet at a face-to-face venue with a face-to-face event happening maybe sometime later this year. Wishing you all a very good evening and hope you enjoyed the sessions today. Thank you.